Let's start off with a brief background for those that aren't familiar with REM. And I'll pull this up really quickly. There we go.
Ooh, look at that. Fancy. Very nice.
Yeah. So Josh is not with us today. He's got some prior engagements, but nonetheless, you've got Adam Beckstead, VP, Partner and Acquisitions Head. Adam, how are you doing?
Wonderful. Reporting for duty.
And Robert Ritzenthaler, President, CEO, and coming to us are you in San Antonio tonight?
Yep.
Very good. How are you doing today?
Beautiful. My flight got canceled, so I'm going to be stuck in Texas for an extra day. I mean, could be worse.
Could be.
I'm not sure you're going to be flying home tomorrow, Robert. I hate to tell you this.
No, Friday.
Okay.
Yeah, Friday. It's all good.
For those that don't know, Robert is located in Sarasota, Florida, which if you've studied any hurricane maps and plans, it looks as though he's in the path.
Yeah, actually, it's flying right over our house as of right now. Super excited.
There you go. Very good. And I'm John Vandergiesen, VP of Business Development and Investor Relations.
And man behind the curtain.
Man behind the curtain.
Right.
Don't know why we can't see me, but we're going to go with it. So REM Capital, we currently operate just over 3,800 doors in 8 states. We've got 3 regions with regional property management heads in each of those regions and 100+ employees now, which to Robert's point last webinar, we had to do a double check because that sounded more than what we thought. So we've been definitely doing some growing, and it's been a lot of fun. So with that in mind, I might just have solved the issue here. Yes. And I'm back.
Nope. He's gone.
I'm going to have to there he is.
Very good. Very good. Very good. So
John's sporting the sweater. Wow.
It's sweater weather, folks. Gosh, it's cold out here in Idaho. It's cold out here in Idaho already. So anyway, so what is new at REM Capital, Robert? Lead us off with your travel, what you've been seeing, what you've been doing.
Sure. Well, spent today, let's see. We drove by our new property, Marbach. Not that I could really do much to get it closed, but always good to see that it's still there and looking great. They're making some progress on the new units that we are anxiously awaiting our CO on, so that's looking good. Drove down to the development deal, spent quite a bit of time there. We had to finish making exterior selections for the clubhouse and the apartments, some stone, designing how we're going to put in the direction and the style of the exterior. Just, a lot of million details on that. So that was good. Visit a couple of comps in the area. I always like to do that every time I'm in the market, just to stay sharp, stay on top of rents, find out what occupancy is doing. We've actually already had a couple people that have stopped by and asked us if they could get on a waiting list. So that was quite shocking, honestly, because we have no signage out, nothing. And they're like, hey, apartments. Yes. Oh, can I get on your waiting list? Sure. So market in San Antonio is pretty crazy still. And we are, obviously glad for that, but it's still pretty good here. I will say the single family home prices continue to rise in this market. I do think at some point it'll probably level off just because of the interest rates and people's ability to afford those single family homes, but still looking good. And then we also took a trip, sort of a celebratory trip up to our 72 acres that we closed last week and just did a little driving around, make sure that the dirt is still there. Nobody's moved it. And actually did a little bit more driving than we did in the last time, just to kind of check out the space, do some little brainstorming on just some of the locations of the units and how we're going to put it all together. And actually had a really good visit with the architect who's leading the charge on this project, working over floor plans and exterior elevations and things of that nature. So a lot to do in San Antonio, and then tomorrow it's off to Dallas. reviewing our 3 properties up there in that market. So that'll be fun. Just meeting with the property managers, the on-site staff, checking in on the renovations, reviewing financials, strategy on the rent roll, all that kind of good stuff. So
Awesome.
it's a big Texas week.
Yeah, no doubt. Well, I know that you're taking great video, and I know folks really appreciate your updates when you share some on boots on the ground video. So that'll be great.
Yeah.
So, Adam, talk to us a little bit about current deals that we have, if you don't mind.
Yeah, absolutely. So as Robert mentioned, Marbach Park there in San Antonio, which looking to close any day now. Just working through some final stuff with the lender. But coming up next beyond that is City Park in Atlanta. Beautiful C-class property. We're looking to lift to a lower B-class status. 208 units with some potential to develop some more on the site. Actually had a building that burnt down that they didn't rebuild. So we have the spot right for it. It's a lot of potential there. And we actually have some little tweaks that we're going to try to do to get some additional units that were originally there. Coming up right beside that is Esplanade in Orlando, Florida. Beautiful, I'm going to say a high B-class, low A-class property in the path of progress. If anyone's familiar with Orlando, right by the Mall of Millennia. Beautiful location, 186 units. This is 2009 product. Just a beautiful property. One of our best looking properties. So I'm really excited about actually both of those properties coming to everyone being able to join with us and invest.
Yeah,
I'm just gonna throw this in.
Yeah,
I think the reason that Adam really likes that property is that in under 5 miles, you can get to all the major sports car dealerships that you ever want. So that's my guess.
Yeah. The exotics, the Ferraris, the Jaguar dealers, they're all right there. So within, what is that, like 4 or 5 minute drive?
Yeah. That's pretty fun. Now, it's a great asset. Both of those, City Park in Atlanta and Esplanade, will be closing in the 3rd week of October. And of course, to Robert's mention, we've got that 72 acres that we're have open right now for development. And that's a pretty exciting deal from my perspective, because you have the opportunity to get that equity multiple from a development style deal, but also roll into more of a traditional cash flow opportunity as well. So that's going to be a really nice legacy style hold for us for quite some time. And it's going to take a while to build too. So, all right.
A big one.
Yeah, it's
Okay,
about I think it's about $100 million project, phase 1 and 2. And then that's not counting phase 3 and some retail and some other stuff. So yeah, it'll be going for a while, but phase 1 and 2, hoping to kick it off first quarter next year. To be fun.
Yep. Absolutely. So let's go with question number 1 from Henry. Adam, this is your question. Talk about investing in syndications, what to look for in an operator, what to look for in an investment.
Yeah, so this is really one of those open-ended questions that I get a lot of times from people, and some people are really trying to get different things from it. But really, a syndication is a great way for people to invest that a lot of people don't know about. It is the best of both worlds, as you're getting huge benefits of the real estate without really doing any of the work. But it does take something up front, because you really have to figure out who the best operator is to invest with that's right for you. And then you have to figure out the best deal, because not all deals are the same. Best operator, really it comes down to who you trust, and you really have to get to know those people. You have to get to know that they know what they're doing, that they really kind of jive with your investing style. And that's going to be all different kinds of structures. You have a fix and flips type of syndications where people come in, they do repairs. They're usually in and out of there in about 2 to 3 years. They sell the property. Or you have the cash flow properties that go on for a longer term. And that's typically what our investment style is. And you're looking for a 5 to 10 year hold. So really, getting to know people like on these Q&As. We have site visits where you're welcome to come along with us. We do due diligence. We invite people to come along with us. Getting to know your operator is very key. And honestly, as a passive investor myself as well, that's my number one thing is I want to know who the actual operator is, not so much the deal.
Yep, great point. I would add on to that communication style, because when you're a limited partner and you're really not, boots on the ground day in, day out, you're not there walking around the asset, seeing what's happening. Those monthly updates, or, sometimes they're not monthly updates, depending on who the operator is, they're pretty important. And so, how are previous deals being communicated about, and maybe ask for some examples of monthly updates or quarterly updates, depending on who they are. I think that's a great way to get a feel for what to expect as a limited partner. Robert, anything to add there?
I think you had asked, part of that question was, what is the syndication? Is that correct?
Talk about investing in syndications, what to look for, and what to look for in an operator and the investment itself.
Oh, okay. Okay, got it. So
Yeah.
just talking about syndications in general. Got it.
Yeah.
Okay.
Yeah.
Well, I guess the one thing I would add to that then would be that there's tremendous tax benefits in addition to having the passive income. So it's kind of, you're directly investing in real estate versus a REIT, which you're going through a publicly traded structure. So you're directly invested in real estate and you get the tax benefits of that direct ownership. The requirement to really be careful is getting to know the sponsor, which Adam talked about. But I think it's important to mention the tax benefits because it is direct ownership versus an indirect ownership through a REIT structure where somebody else is getting those tax benefits versus you as the equity partner.
Great point, Robert. Yeah, we get a lot of people that invest with us that are longtime landlords and have just decided that they're tired of being the landlord. So we get a lot of people that want to sell their portfolio or have recently sold their portfolio and want to put in and invest with us so that we can be that landlord for them. We can do that investing for them, and they continue to get those real estate benefits that they've been reaping for years.
Yep.
Absolutely. Good point. Henry, thanks for that. So next question from Kate, why multifamily? Why now? And what's next for the next 5 to 7 years? What is that going to look like? So I'm just going to find my crystal ball here in the filing cabinet and take a peek.
I was wondering where it went, John. Thanks.
No, but that's actually a really good question, Kate. So why multifamily? I actually sent out an update email to a few folks earlier today talking towards this question. Multifamily is a great asset. I called it the workhorse asset in my email subject line because it is. And whether that's a recessionary period or a period of growth, it has a track record of producing not only from a cash flow perspective, but a tax shelter, equity increases. There's debt pay down by the tenants. There's a lot of different avenues that you benefit from being invested in multifamily. Why now? Well, if we look back at the last recession, because recession is a word that's been used a lot recently, and Fed rate increases, all of these things happening right now, people are kind of really questioning, where should I be putting my money? And looking back at 2008, multifamily did really, really well as an asset class in general. Now, there's always caveats to that. You've got to talk about where was that multifamily asset? What state was it? What metro was it? Who was the operator? How was it purchased? How was it run? All of those different things come into the overall success of a particular investment. But generally speaking, the quote is, well, people have got to live somewhere. And so single family in the last recession got hit pretty hard. And we all know that. And a lot of people tightened their belt and they moved into a B class, apartment. And so we saw vacancies, across the board were about 14%. But again, those are caveats. That's an average. Great apartment complexes really didn't see that much of a dip. Economic occupancy was really great in a lot of instances as well. So I think that those are all really important points to keep in mind. Now, what's the next 5 to 7 years look like? That's probably the $1 billion question right now, just because of rates. And we are doing specific things right now with acquisitions because we believe that it's actually a buying opportunity. Right now, we are getting great, Adam's heading that portion of things up, getting some great discounts on the assets that we're able to acquire. And we're also structuring our debt so that we have maximum flexibility with debt, meaning that we can look to refinance in 3 years, potentially 4 years, 5 years. We're having rate caps with that, and giving ourselves maximum flexibility so that when rates go back down, which we believe that they will, because if you, again, looking back historically, anytime we've had major rate hike increases, the last one was 07, 08, 09, there were 7 rate increases to 5.25, which is higher than where we are right now. They precipitously declined as soon as the Fed felt like they got the situation that they were shooting for. So great opportunity in my opinion. And again, when you look to buy and hold real estate for the long term, you have a higher probability of success. Time is very forgiving for you. And that's what we like to play on, is the side of long-term legacy style investing. So I hope that's helpful, Kate. Guys, anything else to add to that?
Yes, I'll just add, and very well put, John, thanks. I would just add that when you're in a situation like we are today, where the market is, there's a lot of fear in the market and people don't really know what to do. I think you've got to think about two things. One is, if you park your money in the bank and you get 1% and inflation is 8%, you just lost 7%. If you take out an investment in a really risky deal, you could lose everything. So where do you want to put your money that not only is a hedge against inflation, but also is fairly steady over the long run? And like John mentioned, multifamily has proven over the decades to be a very steady performer. Now, there are other asset classes that could get you a higher return, but I think one of the reasons right now that multifamily is so attractive is because it is a solid performer, even in the midst of a recession. So I think that's one point to remember. The other interesting thing is that if you think about this current time from a timing standpoint, and it's true on the development side too, right now we are seeing more ability to negotiate with vendors to get better pricing on the purchase price than we've seen in 10 years. Now, if you think that the whole world is going to fall apart, then I get it. Don't do anything. But if you think historically what's happened, to John's point, the Fed's raised rates, they're always looking at historical data. So they're looking at CPI, which is it's a trailing indicator. So they're going to raise rates too far. They're going to realize it. They're going to drop rates very quickly to make up for that. It's just a fact of the economic data and the timing of when that economic data comes out. So we're in a window of opportunity where we have more leverage to negotiate. And knowing that in the next year or two, when we've completed our refinance, we've completed our construction at a lower basis, we are now going back into the market, getting long-term fixed debt at a lower interest rate. So it's almost the perfect scenario if you're a long-term investor in real estate right now to get a lower basis, do the work, upgrade the property, and then in 2 years when you're ready to refinance at a lower interest rate, boom, you're locked in for the next 7 to 10 years. So it's very counterintuitive, but if you think logically, the business plan actually makes more sense today than it's ever made if you're looking at it from a long-term perspective. So I just wanted to add that kind of thought process in there.
Yeah, very helpful. Thanks.
Yeah, well put.
Adam, anything?
Man, you guys
hard to follow up with that, right?
Yeah, I'm not even going to try.
All right, very good. So Robert, you're going to carry us on into Camilla's question. I would like to learn about cash on cash and maybe discuss IRR, cash on cash, ARR, and equity multiples, just so that people understand what are all these bubbles mean when they look at an offering memorandum. What am I actually getting? What do these mean?
Hang on, let me pull up Google real quick and make some notes. No, I'm just kidding.
How about more so what's more important? What are those things that people should really be looking at?
Sure.
Well, first of all, you got to understand what each one is, and then you have to understand how each one is a data point in your analysis. So first of all, what does each one represent? So cash on cash returns means I'm investing $100,000. I get a $10,000 distribution every year, paid monthly, paid quarterly, paid yearly, whatever. I get $10,000 on my investment. That's a 10% cash on cash return. $10,000 divided by $100,000. Very simple. What's the cash in my bank at the end of the year? Your average annual return is taking your cash on cash return plus appreciation that you're going to get through owning that asset over time, whether it's forced or market appreciation. And you're going to add those two together, average them over the time that you own the asset, and that's your average annual return. So let's just say we get 10% per year for 5 years, and then our property appreciates 5% per year over 5 years. Well, our average annual return is going to be 15%, right? Because we've got 10% cash, 5% appreciation averaged over those 5 years. Now, those numbers are obviously not realistic. It doesn't equate that perfectly, but you get the point. That's our average annual return.
Sure.
Now, our IRR, internal rate of return, factors in the cost of capital in relation to your investment. So if I get $10,000 from my distribution in year one and I spend it all and I don't reinvest it, it's a higher cost of capital. In fact, I took that money out. I didn't have the ability to reinvest it. So internal rate of return says, all right, what if even though you spent it, we actually needed to generate a return on that capital? So it's a lower or more stringent performance metric. So generally speaking, if your average annual return is, let's just say 20%, your IRR may be 16, 17, 18%, depending on the cash flow of that deal. So internal rate of return is the highest benchmark, if you will, when looking at an investment. It's similar to a compound average or compound annual growth rate. A lot of times you'll see that with financial advisors. They'll use that with stock market terms, compound annual growth rate. It's essentially the same kind of concept because it takes in the time value of money. But again, so it's important to know all three of those. Now, I would compare, or I would use both the IRR or the average annual return. Either of them, as long as you're using a consistent measure, either of them are great measures of your total return on your investment. So if you think about, okay, I'm investing $100,000 and I want to make an average of 15% per year, then I want to make sure my average annual return is 15% or more on that particular investment. Now, from a cash on cash perspective, that's essentially telling you how much of that investment am I going to get today and how much am I going to wait for at the end of the day when I sell the property. That's really the difference. So you want to know both of those. You want to kind of understand the difference. So let's just say your cash on cash return is 10% and your average annual return or your IRR is 20%. What that's telling you is that you're getting about half of your return, 10% of the 20, about half of it currently paid into your bank account every month, every quarter. You don't have to wait for it. The other 10%, the other half, you're going to wait until you sell the property. So what we tend to like to do is try to get at least half of our return from our cash on cash return and the other half from appreciation. Now, if you look at a deal and you're getting no cash on cash return, that means 100% of that return is coming from future appreciation of the property. Generally speaking, that would be a higher risk deal versus a property where you're getting current cash flow, which is meaning you're taking some cash out, you're lowering your risk at the end of the day. So that's kind of how those three play together. But I do think it's important to look at both cash on cash and either internal rate of return or average annual return, doesn't really matter which one, so that you understand the relationship between your actual investment and how much you're going to be getting currently and how much you're going to have to wait for. And that's really what it comes down to at the end of the day. Now, in terms of overall benchmarks, generally speaking, in the multifamily space, for let's call it a workforce housing type investment, a B and C class property, which is what we do, a value add. Generally speaking, long term, if you're somewhere in the, let's call it 12, 13, maybe 14% range, that's actually a pretty good return for that space. So if you're exceeding that, if you're 15, 16, 17, 18 plus, you're kind of on the above average side of that scale. Now, recently, most people have been above average because the market has been really good. During the slow times, it's going to slow down a little bit. But on the average, that 12, 13, 14% is a pretty good average. Cash on cash really varies widely. Just really depends on the deal, the operator, all kinds of things. So cash on cash can really change depending on who you're working with. Again, we feel that we want to see at least half of our returns coming from the cash on cash return because it's lowering our risk and it's giving us some money in our pocket while we're waiting for the future upside from appreciation. So I know that's kind of lengthy, but there are a lot of components to this. And if you guys are newer, then I think it's important to, kind of understand the big picture of how they all fit together.
Well, I think the great thing about all that, Robert, too, is, that's a great explanation. And this is going to be a recording too. So folks can always go back to that if they need to redigest what they just heard. So that's excellent. Excellent. So Adam, let's go back to you. Lucy would like you to talk towards financing. I know that you're talking to a lot of lenders right now, and maybe depending on how much time we have, we can also talk towards managing multifamily in general. Kind of a broad question, but what do you need to do for financing a project like City Park, as an example, versus a single family residence?
Great question, and very multifaceted. We definitely do not have enough time on this call to get into those depths, but I can definitely hit some high levels. So
yeah,
definitely the debt market is a very hot topic right now, just with the rising interest rates. So it's very multifaceted, I guess. So I'm trying to think how best to handle this. So
how about this? Let's start out with what is a lender looking for, towards something like what we would do. What are they looking for requirements? What is a good borrower?
Yeah, a good borrower. So what they're looking for is they want liquidity on the partnership side. So on the sponsor side, they want us to have very minimal. I mean, this is like basic stuff. They want us to have 10% liquid in post close. So they want us to have 10% of the loan liquid post close. They also want us to have a net worth equal or greater to the loan that we'll be getting. So if we get a $20 million loan, we have to have a $20 million net worth on the general partnership side. And then we also then have to have $2 million liquid. And that's post-close. So we can't invest that $2 million and then have nothing in the bank. They want us to see that for a cash emergency. Great thing about us is that we like to have cash reserves. Robert's mentioned it many times. For every 100 million under management that we have, we like to set aside at minimum $1 million cash so that we have that as cash reserves. So the lenders love that. And obviously, we like to also keep some in addition to that, but that's our minimum. That's kind of our de facto.
Roberts also has a strict no-fly policy for Adam to Las Vegas as well. So
right, that's true. We also do not approve any deals that have been generated at a Las Vegas event.
Now we're getting loans that are not they're not the typical. So a lot of people are like, hey, you're just going to go to the local bank, like our Orlando deal. We don't go to a bank in Orlando and say, hey, we'd like to get this financed. Typically, a local bank is going to cut off somewhere around $5 million. So we're using nationwide lenders. You have the option of going long-term or shorter-term debt. You can have a fixed rate. You can have a floating rate. Right now, floating rates, if we're going to do a floating rate, we do a rate cap. So we actually hedge our top end of our loan. So if the rates continue to climb, we're stuck at that point, and that rate cap actually pays the surplus there. We also look to determine what kind of prepayment penalties we may have if we're going to exit out of a loan early. Maybe when we want to get into some longer term debt. One of our big things is we also like to get loans that are non-recourse, and this is something that a lot of people don't understand, and I will tell you a lot of local bankers don't understand. I actually had a couple of conversations with some local bankers about that. They don't even understand that non-recourse exists, but essentially these lenders know that multifamily is such a great investment that they're offering a non-recourse loan to us, because they know it's a very slim chance that they're going to have to take a property back. And if they do, they know that it's very valuable. So we're able to get these non-recourse loans on these, and it's a beautiful thing. So I would say, I don't know if Robert, I don't know if you want to add anything to financing.
No, it's great. I mean, the bottom line is that right now the debt markets are a reflection of the general outlook. Everybody's scared. People are worried about, not, the economy crashing, et cetera, et cetera. Very typical, very standard. We see this every, 5 to 7 years. Nothing new. There's always a different reason for it. Actually, it hasn't been 5 to 7 years. It was 2.5 years ago that we saw this with the pandemic. Everybody freaked out and parked their chairs. And then, 6 weeks later, they were like, oh, okay, I guess it's back to business. So we haven't seen that. Thankfully, the Fed stepped in and continued to create liquidity in the market. But I would say overall, the debt market is running pretty scared right now. A lot of folks are thinking that the end of the world is going to be here. And I just don't understand it, because no, the end of the world is not here and it's never going to be here. But I think, we all have to deal with that reality. And I think it's important to have those good relationships with lenders who are more long-term, because there are plenty of lenders who are. And we tend to work with guys that are more like us. They're conservative, they're diligent, they're experienced, they've been through the ups and downs. They're not, they're not worried about the world falling apart. And I would say, generally speaking, similar to us, the folks that we work with on a long-term basis have their own capital. So similar to our deals, we're not leveraged out to the last penny. We've got a lot of our own money invested in deals. We've got a lot of working capital sitting on the sidelines. And the guys that are making loans right now are in exactly the same situation. They're not over leveraged. They control their own capital. They know what they're doing. They have a very experienced team, and they're going to make a lot of deals happen in the next few months. And that's great for them. Similar to what our strategy is. When the world is on fire, we're able to take advantage of it. So that's all I would say as far as the debt market and kind of where things are at today. And I would say going forward, again, I expect that we're going to see continued uncertainty as the Fed does their normal process of looking backwards and assessing things from 3 to 6 months historically. And they will continue to reflect that in their news and their opinions. And people will similarly reflect that in how they behave. And then when it all calms down, everybody's going to jump back in and it'll be great again. But that's kind of where we're at today. So again, it all comes down to what do you consider an opportunity? Well, an opportunity is where everybody is seeing one thing when reality is moving differently. And that's where I feel like we're at today. Inflation is coming down. Job numbers are still strong. The Fed's telling us that the end of the world's going to come. Yes, I get it. We don't want wage growth to continue unabated forever. But this is the same guy who also told us that he wanted to let wage growth run because it's so far behind. So again, you kind of have to have a big picture here, or else you're going to get lost. And I'm sorry for going off on a tangent, but there's just a lot to this.
Yeah, no, these are great questions because you can go down a few rabbit holes for sure. Circling back, Adam, on financing, had a quick clarifying question from Mike. Explaining non-recourse, if you could.
Yeah, absolutely. So maybe it's best to talk about recourse and non-recourse. Recourse loans, if you go get a mortgage on your home, that is a recourse loan. If you default on that, say you bought it for $300,000 and the bank had to take it back, you still had a $300,000 loan on it, and they only sold it for $200,000. They have recourse to come against you to get that additional $100,000. Non-recourse is they take the actual asset as recourse against that loan. So multifamily property, as an example, if there was any sort of default, they would take the property back and not come after you for the additional funds.
Awesome.
And I'll just add that if you're buying your house for $300,000 and borrowing $300,000, you're going to be in default at some point.
It's a VA loan. What are you talking about? They got the 0 down.
Trying to create some round numbers, Robert.
Love it. I love it. Love it. We don't do that, by the way, folks, on our multifamily deals. I think Adam does that only on his single family, but it is. No, I'm just kidding.
All right. So, Robert, Mike would like you to talk about the 100% bonus depreciation and 2022 being the last year. You mentioned that in a recent email update.
Yeah. And actually, I'd like to circle back since I kind of rudely interrupted Adam. He only got to talk about recourse. I think it's important to talk about non-recourse a little bit more too, because non-recourse essentially says, hey, you're not on the hook unless you, what they call bad boy carve-outs, meaning if you're a bad boy or girl, then we're coming after you. And basically bad boy carve-outs, generally speaking, fraud, gross mismanagement, although generally it's intent at the end of the day. If you intend to purposefully run that property in the ground and not pay your debts, they will come after you. Generally speaking, outside of that, it is non-recourse. So we, obviously that's a negotiating point. Some lenders want things like insurance. If you forget to put insurance on your property, the building burns down and we cannot collect on the insurance policy that you were supposed to have. Guess what? We're coming after you. So there are certain things, that are negotiating points on these loans. Now, that being said, just remember, if you are an LP, a limited partner, which is, an investor, let's just say, in a syndication, you are protected against any recourse versus investing directly in a piece of real estate yourself, where you are now either recourse or non-recourse. So that's a big distinction too. And a lot of people don't understand that. So as an LP, you are protected. Your capital is the most you can lose. You cannot lose your, more than that. There's never going to be that personal guarantee. Even if the people that you are investing with happen to be extremely fraudulent, nobody can come after you as a personal guarantee. So it is one big benefit of being an LP in a deal, limited partner in a deal, is that you have that limited exposure. Obviously, we don't want to, lose our capital, but the recourse, non-recourse thing is important to do. So I just wanted to throw that in there for a little more explanation. Now, getting back to the cost seg question. So yes, 2022 is the last year that we're able to take 100% accelerated depreciation from a cost segregation study, meaning that if in 2022 we had a $20 million cost segregation tax loss, we're going to take the entire thing. All $20 million of that is going to be deducted in 2022. Starting in 23, it goes to 80%. 24, it's 60%. So each year they're going to cut 20% out and they're going to phase it out over a 5-year period. So that $20 million in 22, if you invest in a deal, close a deal in 23, theoretically, that's going to go down $4 million. Now you only get to take 16 million of that 20 million. So it's a material number and it does affect the overall benefits that you're going to get from the property. Now, it's not a cash item, obviously, it's a tax item, but it means that over the long run, you're going to be able to take less distributions and less money out of the deal tax-free versus what you could do today. So right now, this is our last year to get the maximum benefit from that. Now, there's a chance November, December rolls around and Congress decides to extend that. Right now, we have gotten zero guidance from anybody on that happening, but theoretically it could happen. A lot can happen in November. We just don't really know where things are going to end up. But that is important to note because the deals that are closing in 22 will still be at 100%.
Awesome.
Yeah.
That's great.
And if I could add to that, with this is always potential to extend this and pass it. And even if it doesn't go this year, it could be next year. I think that if nothing happens and it tapers off in 5 years, this gives us an opportunity for a new program to come in. Because what you got to know is that these people that are passing laws, they're real estate investors. There's a reason why these tax benefits happen in real estate, and it's because the people that make the laws do it. So they want the same benefit. So even with this tapering off, I think that we will definitely have a program that would come in to give us an equal opportunity for real estate.
Let's hope so.
Yeah, well, I certainly do it, but real estate is such a powerful driver in the economy overall. I think that there's always going to be some sort of incentivization for folks to do certain things in real estate. So let's hope that keeps going. We've got a couple of chats happening here, chat questions. Is there a minimum amount recommended to invest in a syndication for a first-time investor? Absolutely. I would say be conservative, do a lot of due diligence, a lot of educating yourself, getting to know people, getting to know different operators and sponsors, and really figuring out what's important to you in that space, and then also looking at your personal finances and what's going to be most appropriate. Some folks, maybe they're not at that $25,000 mark yet, the 50,000, 100,000. I know that I've heard multiple people say, don't invest into a syndication until you have $100,000 saved. Other folks might argue maybe that's 50. So really, it depends question for sure. But I think that it's got to make sense for you and where you're at with your time horizons, with your active income, lots of different, things to navigate there. And I talk to people, double-digit people a week about what should I do, how much should I invest, all these sorts of things. And of course, I'm not a financial advisor, but I love helping people just discuss, hey, this is where you're at, what makes the most sense for you. And honestly, sometimes what we do isn't for everybody, but I think it's important to find some folks that are doing things in the space that you want to be in and ask good questions. So,
John, I'd like to add something to that as well, kind of tagging off what you were saying about each person's sort of perspective and what they're looking for. And I will say, generally speaking, if you are investing, call it $5,000, that would be more what in the industry would be considered crowdfunding. And if you know anything about crowdfunding, it's small dollar amounts with lots and lots of people. So it's a very different experience as an investor versus somebody that has $100,000 that comes into a syndication like ours. You are going to have a very a much more, I would call it, assembly line experience in a crowdfunding type investment versus a more personalized experience with someone or a group like ours. So I think that's something to consider, because if you really want that one-on-one attention, if you want to learn, if you want to grow, if you want to talk to your sponsors directly, you're going to have a much better chance of doing that if you have a larger dollar amount. Now, again, it doesn't mean that you have to, but I would say that's probably, to me, the biggest determining factor of whether you'd want to put $5,000 in or wait until you have 50 or 100, because you're definitely going to get a very different investor experience. You're going to get a different type of investment. And again, if you have an even smaller amount, $1,000, well, then you're kind of back to that real estate investment trust, publicly traded REIT investment opportunity. You can go on Schwab, open an account, put some money into a deal like that all the time. But again, if your syndication allows you to put in $1,000, something like that, it's a crowdfunding type model, and it's not based on an individual investor as much as a larger investment is. It's just kind of a factor of time and attention. So there's a practical aspect to this too, I think, to consider, and what you're wanting to get out of it. And again, if you have $1,000 to invest and you want to put it in 100 different deals, you got to think about all the paperwork and all the research you have to do and all the stuff you got to keep up with. And you're not going to have a whole lot of single, focus from your operator. If you're able to save up $50,000 to $100,000, generally speaking, you're gonna have a very different experience. So anyway, not to be a dead horse, but I think it's important to think about that as an intangible aspect of a minimum amount to invest.
Certainly.
Yeah, you guys aren't giving Jeremy enough credit. He's trying to understand. He's got $5 million to invest. He's trying to figure out how much to invest on his first one.
Right.
I will certainly have that phone call, Jeremy. Maybe I'll call you right after. I
would add to that, though, on the flip side, to Adam's point, if somebody comes to me and says, hey, I've got $1 million, what do I do? I always tell them you're going to want to diversify that investment over several deals. So even if you do have $1 million, don't put it all in one deal. I would say, hey, spread it over 5 deals, 10 deals. Make sure you get some good diversification in there. So again, that's more of an asset management, asset diversification strategy that would come from the other angle of how to invest, a minimum amount to invest. So
Sure.
Yeah.
I'm going to give a quick example of a call that I had a few weeks ago from a kid that was 23. He had $50,000 saved. He was very excited to start investing in real estate. He was making about $10,000 to $12,000 a month. And so I listened to his particular scenario, and I was, he was really excited. And after, asking a few questions to get a really good idea about where he was at, I said, well, what I'm going to tell you is actually not what you're going to want to hear on this call. I don't think that you're going to want to invest in real estate right now. And I said, and he said, well, why is that? Because I said, well, your return on this $50,000 invested is going to be far less than if you reinvest into this business that you have moving at a really great clip right now. And so I just asked a couple of questions about, well, how could you utilize this money and reinvest it back into your active income business so that you could get that doubling potentially, if not more, and in a relatively short amount of time. And then at that point in time, he has even more income, investable income to do things with. So again, it just depends on your specific circumstances. So
that's a great point.
Anyway, let's move forward here. So Mike had another question. On average, about how long does it take for an investment to be seeing the 8% preferred rate of return, the goal versus the reality? So that's a good question, Mike. I would say towards our portfolio, Robert, and correct me if I'm wrong, I believe that every one of our assets that we have held for over 24 months, we're at that 8% preferred rate of return.
Yeah, I would say 3 to 5 years. That's kind of my standard answer. We're going to get there within 3 to 5 years. Some sooner, some. Well, I don't know if I would say some slower, but yeah, 3 to 5 years is a pretty good. And I know that's a big window. Like you said, we've been hitting it more like 2.5 to 3 years.
Strong market.
But yeah, I think that's a pretty good number. I mean, our goal is to get to 10% within 5 years. So obviously we got to get to 8% to get to 10. So.
Yeah, and that's average.
That is average. And again, real estate has so much nuance. It's unbelievable. So that, where's the asset? What's going on? What is the vintage? What's the renovation plan? I mean, you could talk a long time about, how the modeling is going to work and what's really happening on a day-to-day basis. So,
yeah. And I would say, again, a great example of the nuance that you just mentioned is that right now we're paying a lot more in interest than we were a year ago. So that's going to cause the current investments to lag the first year or two on their cash returns. But on the flip side, it's also going to mean that whenever we do that refinance, they're going to pop a lot more than the deals that we might have done with fixed long-term debt from day one. So you've got to kind of understand the ebbs and flows of the market and how that's going to look and what it means from an individual standpoint. So,
sure. Let's get over to Peter's question. And he was asking about the Wyoming partnership that we create, the LLC structure in a deal. And he said, is it that I don't have to file an additional tax return because of Wyoming, regardless of where the income is actually derived from? So I think that's a pretty important one to go over. And Robert, step in here too. But no, you still do need to file tax returns in each individual state. There are 8 states that do not have an income tax at a state level, and we do hold assets in some of those states. So that's a nice thing there. But yes, you do need to equate that into your tax returns.
Yeah, and I was going to say the reason for Wyoming isn't necessarily the lower tax bracket. It's because Delaware used to be the go-to spot for everybody to create your corporation because it was legally more friendly. And so Wyoming they've seen that and they said, hey, not a lot going on in Wyoming. Let's help our state revenue out by creating a very legally friendly environment. and they happen to be a lot cheaper than Delaware when it comes to your annual filing. So I'm probably going to be off on my numbers here because it's been a bit since I did the comparison, but I want to say that Delaware, you're going to be paying anywhere from $200 to $500 per year per entity. And you're certainly going to have a very pro-business legal environment if there's any lawsuits or anything. But Wyoming is like $50 per year. And I know that doesn't sound like a lot of money, but if you're a company and you have hundreds or thousands of different LLCs, you're talking tens, thousands, hundreds of thousands of dollars in fees that you're saving by going to Wyoming versus Delaware. So that's the bigger reason that a lot of people are moving to Wyoming versus Delaware. Yes, there's no state corporate income tax, so that's nice as well. Any pass-through income that isn't, that could potentially be taxed in the state where you're living is not, obviously, if you've got your Wyoming domicile. But the main thing is the legal aspect and the cost, sorry.
Sure. Yeah, absolutely. We had another question here. Jeannie, you said that you have over 100 employees. Yep, absolutely. And how many investors do we have in total on all of our properties? That's a great question. We'd have to go back.
More than 100.
Oh, certainly. More than 100. I would say actually more than 100 regularly repeating investors and across the board, whether they've invested once or, a few times, a few hundred. But a lot of that growth at REN Capital, and I know that Adam and Robert and Josh are very proud of this too. That's basically friends and family and highly repeat and referral based people. So we really enjoy that about how this has grown.
Yeah.
So
yeah, I was going to say, I think you're about right. I think we're somewhere in the 300, 400 mark, I believe, total number of investors. Then each deal has, plus or minus about 40 to 50 folks that'll join us on a project, depending on the size and depending on how many, what the check size, obviously.
Yeah, I get that question a lot. Because people are trying to shape the deal in their head and like, okay, so I'm a limited partner, and how many other people are in that? And I'm like, well, if it's a $10 million raise and two people come in at $2 million each, whether that's a 1031 exchange scenario or whatever that might be, that's only leaving $6 million left for folks to come in at 100, 200, whatever they come in at their dollar amount. So it's highly dependent, but I would say, regularly 40 to 60 folks on the limited partner side. So, man, guys, that was a quick hour.
Nice. Did we answer the question from Aaron? He said, what's a realistic exit cap rate for multifamily?
Oh, we did not. Thank you for catching that. I was over in the questions and forgot to chat.
That sounds like a super interesting one.
Yeah. Aram Khan said, what is the realistic exit cap rate for multifamily these days? Adam, you're looking at a lot of cap rates right now.
Well, that's going to highly depend on what the asset is and where it's located. I mean, huge swings. And a lot why we invest in the Midwest, Southeast, and Texas, because we have a multifaceted group of properties. But if you're Class A, Class B, Class C, Class D, those exit caps are going to wildly swing from anywhere down into like a 3 cap, or maybe even under a 3. All the way up to, you're probably selling D's in the 10 to 12 caps.
10 to 12s are back? Maybe they never went away. They never went away.
We just don't invest in those, John.
Very good. Yeah, I know that there was a lot of cap rate compression for quite a while, and I don't think that that's actually changed drastically by any amount. And I know, markets like Austin, Boise, as an example, I mean, we were seeing cap rates far below 5. And again, this is dependent on what the asset is, what the location is, et cetera. But I mean, it is market dependent. But I think another point to bring up is, what are we feeling as though our cap rates are going to be like when we are exiting a deal?
Great. And I did want to touch base on that, because we are actually, let's say we buy a property at a 4 cap because the property is underperforming. We know that we can come in there with better management. we can come in there and do some renovations and really lift the income of that property. And so that when we get that lift in there and we're at a stabilized value, maybe that 4 cap that we bought at the entrance is now a 6.5 cap. That is very real, and that happens. But we're actually coming in there, and let's say we want to exit. So we actually project, let's say we put 5.5 cap from day one, and we say we want to exit in 5 years. We're going to increase that 1/10 of a point every single year as we go on. So in 5 years, from up that 5.5 cap, it's going to be a 6 cap. In 10 years, it's going to be a 6.5 cap, and that's in our underwriting module. We're not projecting, hey, we're going to get 3 caps in 5 years, and that's how. I mean, anyone could throw that in there and make the worst deal look fantastic. That's not what we're doing. We're actually projecting that our exit cap's going to be worse than most likely what it's going to be.
That's great. Great spot to quit, guys. Everybody, really appreciate you tuning in. Great questions. Hopefully it was valuable, and we'll keep doing them if you guys ask for them. So, gentlemen, thanks a lot.
Thanks, John. Appreciate
Thanks,
it.
everyone.
Take care.
See you guys.